It's the Larry Kudlow Show. Free market prosperity starts here. Now, here's Larry Kudlow.
Welcome back, everybody. I'm Larry Kudlow. This is the Larry Kudlow Show. By the way, you can listen to this radio broadcast on the internet. You can live stream us. LarryKudlowShow.com, LarryKudlowShow.com. You can get us all across the country, around the world, throughout the solar system, including the Milky Way. And during the week, please join us on Fabulous Fox Business Network. Name of the show is Kudlow. Mondays through Friday, every day, 4 p.m. And if for some reason you can't get around at 4 p.m., why, just text your favorite 9-year-old. She will show you how to DVR the show. You'll never miss a single thing. Doesn't look like a great week for stocks. Let's see, the Dow is off over 1,100 points. NASDAQ flat, S&P 500 down a wee bit. I still think gold is the big shining investment. Gold and silver have done awfully well. Maybe we can talk about that. But bond yields are rising for the week. The 10-year was up 16 bips, 4.25%. It was 360 not too long ago. Maybe that's affecting stocks. Let's talk to our experts. Nancy Tengler, CEO and Chief Investment Officer of Laffer Tengler Investments. Nancy's recent book, The Women's Guide to Successful Investing. And my pal Dave Bahnsen, Bahnsen Group's Chief Investment Officer, founder, managing partner, author of the Dividend Cafe.com. And his great recent book, Full-Time Work and the Meaning of Life, very dear to my heart. Anyway, kids, thanks for coming on. Nancy Tengler, start with you. Bond yields going up, affecting stocks, I guess. I mean, if the discount rate, the 10 years, the discount rate goes up, I guess that means the present value of future earnings goes down, so that would be bad for stocks. I don't think it's a horror show, but what do you make of it?
Yeah, well, thanks for having me. It's good to be on with you and David. Hi, David. I guess since the Fed cut and was overly enthusiastic, in my view, with their 50 basis points, the 10-year has risen 63 basis points, and it's hovering at 4.25%. But we went back and looked at stock returns, and it seems the freak-out period, at least in recent years, has been like 4.7%, or certainly well above 4.5%. And that's when we saw the sell-off, the last sell-off, when the 10-year hit that level. But if you go back to the 90s, Larry, and I think Greenspan really understood productivity-driven growth, and that's what we have now. And I think we have it in spades compared to the 1990s. But the Fed funds rate stayed above 5%, and in 1995 he only cut twice, 2 25 basis point cuts. So I think what the bond market is telling the Fed is that's enough for now, though I don't think they'll listen. And let's let the economy continue to. It's pretty hot if you think about it. 3% real GDP growth, or 3.4 if you look at GDP now in a declining inflation environment is certainly a slowing, but it's pretty compelling. And so I think that, and the job market is good. It's not great, but it's good. And so I think the Fed needs to pull back a little, and that's really what the bond market's trying to tell it.
I want to come back to the Fed in a second, but David Bahnsen, just as a counter thought, to some extent, maybe to a large extent, is this deficit spending-driven growth? When you look at the components, it's consumer spending, it's government spending, it's government-adjacent spending. It's kind of distorting the numbers. I mean, we've never had deficits are running 6-7% of GDP at this late stage in the business cycle. And as Nancy said, with 3% growth or so. Deficit spending-driven growth, what do you make of that?
Well, the problem, Larry, is that from the financial crisis until COVID, we were running massive deficits, and we were not seeing certainly not 3% real GDP growth. We were seeing 1.5. It averaged 1.6 for years. It wasn't until supply side reforms came in with corporate tax reform and foreign profit repatriation and energy independence and deregulation that we even had 1 year of 3% real GDP growth. And it's funny because Nancy's exactly right. You see the GDP number right now a little higher, but the idea that the three of us have to refer to it as running hot, 3% should be table stakes. That's the regular post-World War II, real GDP growth.
Yes.
So all the expectations have been reset, and that is a byproduct of excessive government spending, putting downward pressure on growth. Resources are not getting allocated to the most efficient, productive use, Larry.
I mean, it's ironic. Okay, here we are 10 days to the election. It's ironic. Kamala Harris is running against the Trump tax cuts that you were just describing. In a sense, I think it's you can argue that the Trump corporate tax cut itself, which is still in place, they've done what they can, most of it is still in place, is perhaps one of the biggest drivers of what growth we have. I mean, think about the irony of that.
Yeah,
Larry, if I were a Harris campaign enthusiast, I would practically be willing to admit that. It is so obvious. You are 100% correct. And the other thing I'd add is the foreign profit repatriation.
Yes.
Kevin Hassett thought it was going to be $1 trillion. It ended up outperforming his expectations by 70%. I mean, there was a massive amount of money that came back on shore and has been put into the economy, and the Biden administration has lived off of that capital from those two policy decisions.
Even though they hate it. I mean, that's so good, so great. No, it's wonderful. It's a very good point. Nancy, I don't understand Fed policy. I don't think they should have cut 50 basis points at all. You know, prices in this country never seem to fall, and we didn't even get back to the target. And I think that the Fed could have moved the target, like if it's 0 to 2, you could aim for 0 growth or 1% inflation. Maybe prices will fall for middle-income people and lower-income people. Now the Fed is sort of being embarrassed, having done what they've done. And my question is, what's next for the Fed? Are they going to raise the target rate back or what?
I don't think they will. I mean, I think what this Fed has shown is that they can't learn. And they've made mistake after mistake. They were way too late to the party, hiking rates and shrinking the balance sheet. Now you're starting to hear that QT is over or will be over in 2025. And I think one of the things that's so unfortunate is that it has a real world impact. And so if you look at the cost of servicing the debt, for example, and you look at the debt, let's start there. 35 trillion, some say 35.8, I think is the most recent number. Add in 7 trillion from the Fed's balance sheet. I mean, this is third world country status, and the cost of servicing the debt is approaching $1 trillion a year. It's 870 billion. But as we continue to use debt to pay, interest on the debt, then that number is going to grow exponentially. But I think they put themselves in a very difficult position. That does not mean they won't cut 25 basis points at the next meeting. They may. I don't think they should. They shouldn't have cut 50. But what we know is that there's no humility at this Fed. And then I would just go back to your original point, which is absolutely right, and David's too. Corporate tax receipts have doubled from $200 billion to $400 billion since the Tax Cut Jobs Act was signed into law. So I find that amusing and fun because rates matter. And when you cut rates, you get more of what we know that from our friend Dr. Laffer. You get more of what you're incenting. And so I'm hopeful that what we will see is a renewal of those tax cuts, or even lower on the rate, and then seeing 100% expensing put back in place, because construction spending, tech spending, innovative spending has skyrocketed since then.
David Bahnsen, not one official governmental Nobel Prize-al, IMF-al economist believes in the Laffer curve. And what Nancy Tengler just said, what you said, is exactly right. Revenues have doubled. They're way above. You could go back 2017, take a look at the Congressional Budget Office estimates of tax receipts, particularly corporate receipts, but not only corporate receipts. Go back to that. Look at their 10-year estimate. We're still in the 10-year window. We are so far ahead of what they predicted. I mean, they predicted a big decline in revenues. Everybody. I got 26 Nobel Prize winners coming out against Trump's tax cuts, for example. I got the IMF just making a statement coming out against Trump's tax cuts. Tax cuts will be inflationary. Whoops, wait a minute. No, they weren't. It was the big spending bulge that caused inflation. But why is it? Why is it all these officials, whoever they are, these official agencies and prize winners, and you can get a free vacation to Bali if you get a Nobel Prize. Why can't they get this right? Why don't they see the Laffer curve? By the way, Laffer should have won a Nobel Prize. Why don't they see that? What is wrong with them, David Bahnsen?
Well, look, I wish I knew the answer, but let's just at least point out that your old pal Bob Mundell did win a Nobel Prize.
Yes.
He certainly appreciated the Laffer curve. Look, the three of us are all on the same side here, okay? There's just no question. It is a political reason to not believe in the Laffer's curve. It is not economic. There is prudential reasons to debate where spending cuts need to come in with tax cuts. There are prudential reasons to wonder what the right marginal rate is on the Laffer's curve, but there is no philosophical reason available after Kennedy, Clinton, Bush, and Trump to deny that cutting marginal rates increases productivity and what Nancy just said, the thing you want to incent. But because we agree so much on this, let me push back a little bit about something on the Fed, because I don't think it is true that they believe that they're making a mistake. I think that this is all very much on purpose. And let's be real clear about what the bond market is saying. The 10-year has gone up 40 basis points. You know how much inflation expectations and tip spreads have gone up? 0. It's all real GDP growth expectations. It's pushed the nominal yield of the 10-year higher. The Fed knows they can't say it. They're not going to say it. They know the reason they have to cut rates is because of the government spending, because of the amount of debt that's about to reset at higher rates. $1 trillion of commercial real estate, $1.3 trillion of corporate borrowing. They know they froze the housing market. So they are cutting rates despite price signals, whether it be growth or inflation. And I don't think this is an accident. I think they have to do it. And the reality here is that they probably are going to bring $500 billion a year out of the deficit because the term structure of government debt is so short term. If you get that Fed funds rate down to 3%, a 90-day T-bill down to 3%, you're taking $500 billion out of the deficit. That's why they have to finance these government deficits using monetary policy.
Well, okay, that's a pragmatic somewhat cynical view. Okay, I hear you. But, let me go.
I call it a Japanese view.
A Japanese view. I'll go back. You mentioned Robert Mundell, who was a very dear friend and a mentor. I mean, I saw him a lot in New York. He taught me a lot. I plowed through some of his books. It was heavy going. I'm not a PhD expert like him. But Bob Mundell, when you boil it down, argued for the tax cuts and tight money. Tax cuts and tight money. He revolutionized fiscal policy by saying, no, it's the tax side that matters, not the spending side. He beat the Keynesians. And regarding the Fed, he wanted what he called tight money, by which he meant a steady gold price, a steady value of the dollar, and a zero inflation rate, low inflation. That nobody talks in those terms. I mean, Laffer still talks in those terms. I try to talk. But I'm just saying he won a Nobel Prize for that. They acknowledged it. Now, this was by now a long time ago. I forget. I mean, we may be, about 30, 35 years since Mundell won. He's passed away. He was a wonderful man. But I'm just saying that analysis is gone. It's, in all these.
Economics hasn't changed, Larry. Politics has changed. He didn't have the luxury of saying it with 120% debt to GDP. Yeah. So the government has put it in a position now where the Fed is held hostage by excessive debt to GDP. When Mundell was writing that, we were at 45, 50% debt to GDP. He was right, but we cannot afford a 5% Fed funds rate with $2 trillion deficits and $35 trillion of debt.
Well, might be fun to try. Anyway, let's take a quick break. Very interesting. David Bahnsen, the Bahnsen Group, his book, Full-Time, Work and the Meaning of Life. Nancy Tengler, Laffer Tengler Investments, her book, The Women's Guide to Successful Investing. I'm Kudlow. Be right back on Stocks.
This is the Larry Kudlow Show. Now, back to the Larry Kudlow Show.
We're talking stocks. Two of the best, Nancy Tengler, Laffer Tengler Investments. And go after her book, The Women's Guide to Successful Investing. David Bahnsen of the Bahnsen Group and his book, Full Time, Work and the Meaning of Life. David, last thought on this. Okay, I want to hit gold and silver before we lose. We only got a 4 minutes. With respect to the Mundell model, all the things you said about how the Fed has to finance these horrible deficits and so forth. You know what? Mundell would say the solution to these whacked out finances is fiscal policy, not monetary policy. He would say lower marginal tax rates. Now, he would also say cut spending because he believed in that too. But that's what he would say, not that the Fed should accommodate, but that we need radical change in fiscal policy. And I think because you raise a very important provocative point, how you put it before the break. It's very important and well said. And I was thinking about it, and I was saying, you know what? You're right, but I got a different solution. And I don't know how this is going to turn out. As I keep saying, polls are not votes. But if Trump wins with an Elon Musk and other people, Howard Lutnick, you got a lot of people new in the Trump orbit who want to cut spending and tax rates. I think that's the way to go. I don't think the accommodative Fed should be the policy lever.
So I 100% agree as far as what should be the case.
Yeah.
I'm referring to Fed policy in the context of what is the case and also what I think will be.
Yeah.
I'm predicting it. It doesn't mean I think it's right.
Yeah.
I'm with you, and I'm with Mundell, I'm with Nancy, I'm with our friend Dr. Laffer. But here's the thing. When Bob wrote that, mandatory spending was 30% of budget. It's now 70% of budget.
Yeah.
The discretionary room for fiscal cuts is just not there. The entitlement state, the welfare state, these things have grown out of control.
All right,
so
we got to go. I'm sorry, Nancy Tengler. I was going to ask you about gold and silver. We'll talk some more. It's great stuff. Nancy Tengler, David Bahnsen, Robert Mundell, thank you very much for weighing in. We appreciate it. Folks, Money in Politics, Liz Peek, Charlie Gasparino coming up next.
My dad works in B2B marketing. He came by my school for career day and said he was a big ROAS man. Then he told everyone how much he loved calculating his return on ad spend. My friends still laugh at me to this day.
Not everyone gets B2B, but with LinkedIn, you'll be able to reach people who do. Get a $100 credit on your next ad campaign. Go to linkedin.com/results to claim your credit. That's linkedin.com/results. Terms and conditions apply. LinkedIn, the place to be, to be.